I would start by recognizing that this is the Special Committee on Race and Insurance Underwriting Interim meeting here today, Friday, June 18th, 2021, starting at a little after 1 o'clock in the afternoon here in the East. And with that, I'd ask Will to take the roll.
Okay, thank you, Mr. Chairman. We'll first start with committee members. Indiana Representative Matt Lehman.
Here.
Kentucky Representative Joe Fisher.
Here.
Louisiana Representative Edmund Jordan.
Here.
Michigan Representative Brenda Carter. New York Assemblyman Kevin Cahill.
Here.
New York Assemblywoman Pam Hunter.
Here.
Ohio Senator Bob Hackett. And we have Chair Breslin.
Here.
Okay, so we do have a quorum present, Mr. Chairman. So I'll move on to the all other legislators who registered for the call, non-committee members. Kentucky Representative Jim Gooch.
Here.
Kentucky Representative Rachel Roberts.
Here.
Kentucky Representative Sherlyn Stevenson. Maryland Delegate Veronica Turner.
Hey, Will, this is Bob Hackett. I just wanted to let you know I joined the call. I couldn't get my Zoom to work, so I'm just joining by phone. Thank you.
Okay, thank you, Senator. Maryland Delegate Veronica Turner. Maryland Delegate Courtney Watson. Maine Representative Poppy Alford. Missouri Senator Stephen Roberts. Mississippi Representative Hillman Frazier.
See if you can get me on.
Okay.
Montana Representative Andrea Olson.
Wait a minute.
North Carolina Representative Rosa Gill.
Will, folks, again, if you're not speaking, please mute your line. There's a lot of background noise on someone's line.
North Carolina Senator Vicky Sawyer. North Dakota Senator Sean Veda. New York Assemblyman Jarrett Gandolfo. New York Senator Pamela Helming. Pennsylvania Representative Tony DeLuca. South Carolina Representative Carl Anderson. And Washington Representative Sharon Tamika Santos. Okay, any other legislators present that I did not call? Okay, I think you're all set, Mr. Chairman.
Very good. Thank you very much, Tom, and welcome to everybody. It's a difficult day to have this kind of a meeting, but it's our recognition of a new holiday, the first federal holiday in the last 40 years. And with that, I will turn it over to my dear friend, the president of NCOIL, Matt Lehman. Matt.
Thank you, Mr. Chairman. I know everybody's applauding, but with the mute, I can't hear it, but we'll move on from there. But I want to thank everybody for being on this call today and joining us. And I want to second what Chairman Breslin has said in recognition of this new holiday. It is, as a Civil War guy, it's always beneficial we keep that sense of history in our minds, no matter what the issue is and what we're discussing. As you know, Senator Breslin will take the helm today on this committee, but I just want to, first of all, thank everybody who's been involved in this. I believe this is our 4th meeting of the committee. I think we've had over 10 hours of testimony. And to be honest with you, as someone who has sat through a lot of that, I'm really pleased with what we've seen. We've seen a lot of diverse presentations and views offered by others, and that has been done respectfully to all presenters, and I really appreciate that. Lastly, the filter of all this to me is, NCOIL is an organization charged with upholding state-based insurance system. Accordingly, we've had conversations, and some of these have not been easy. But I think it's very critical that NCOIL take the lead on this and be active in this, because as we meet today, there's federal legislation, there's federal regulation that's under threat or being proposed out there that would usurp what we are charged to do under McCarran-Ferguson. So I think it's key that we continue these discussions, and I think we'll work diligently to uphold those responsibilities. I look forward to the discussion today. I think these are important issues. And with that, Mr. Chairman, I'll turn it back over to you. I hope to see everybody in Boston next month. And again, Mr. Chairman, looking forward to today's discussion.
Thank you very much, Mr. President. And I look forward to a very robust discussion today. We had a very good discussion in furtherance of the committee's second charge, discussing certain rating factors that are used in underwriting at our last meeting in April, where we heard from several key speakers with very different views. Purpose.
Guys, Senator Doty is going to go through the document. She'll give lots of details.
Folks, again, we can't remind you enough to please mute your line if you're, unless you're the person actually speaking at the moment.
If it was just New York State, I'd say it was a protest of going on, but I'm sure that's not the case. The purpose of this meeting is to continue the discussion to gather more information for the record and to determine whether unfair discrimination exists in the specific rating factors of zip code, education, and occupation, both as separate factors and in combination. We do have evidence in the record on the use of education and occupation, but that testimony seemed to reflect their use as a single joint factor. As I have had others have referenced previously, conversations surrounding rating factors must start with stating what the law is, and that is, as a general matter, that disparate impact has always been legal within the framework of the insurance industry, but sometimes where there is overwhelming evidence that disparate impact amounts to unfair discrimination because of, for example, a rating factor's negative impact on a protected class, state legislators decide that even if certain factors can be actuarially justified, social considerations warrant that they may be exempted from the core standard or risk-based pricing. Thus, the evaluation is a two-step process. First, does this factor meet the requirement of being actuarially justified? And second, if yes, then does it nonetheless rise to the level of unfair discrimination? That's the key question that we all have to answer. This is what happens across the country in state legislatures when deciding whether or not to prohibit insurance from using certain rating factors in underwriting, and that is what we are doing today. That brings us to the format of today's meeting. We'll first hear from our panel of speakers. Once they are finished, we'll hear any comments or questions from the committee members, then from other legislators, and then from interested parties. Let's move quickly. We have an hour and a half scheduled, and we'd like to do it on time and get out of here on time. So let's get started. The first of the 5 speakers will be Doug Heller, who's an insurance expert from the Consumer Federation of I almost said of New York. It's not of New York, of America, which is relatively the same. We make that mistake frequently.
Right. Well, thank you, Chairman. Thank you, Chairman Breslin, Representative Lehman, and committee members. Appreciate the opportunity to join you today. I'm going to separate my discussion into 2 parts. First, I'll talk about education and occupation separately, but as kind of one part of it, and why those, in our view, have absolutely no place in pricing or underwriting. Then I'll talk about the use of geography in rating, which is, as you all know, rife with problems and burdened by the legacy of redlining in significant ways, but which also can be considered through a somewhat different lens, because while there's absolutely no causal relationship between your educational attainment or job title and your driving, with geography, there are arguably causal connections to driving and driving risk that are worthy of a different discussion. But first, I need to start by noting that at Consumer Federation of America, We see the whole suite of non-driving socioeconomic rating factors linked together as a broader matter of public policy concern. So while some companies place emphasis on education and/or occupation, others do not, but they may heavily weight credit history or home ownership or marital status. So while we should address the factors on today's agenda, I think it's important to keep in mind that tackling them will not alone remedy the problem of racial, ethnic, and economic disparities in auto insurance pricing. So with that caveat noted, I'll start with pricing tied to motorists' educational attainment. Insurance companies that include this rating factor, and there are several of them, the major companies that do, will charge higher rates if you have less education and reduce your rates if you have more. If you went straight to work right out of high school, when you're 40 years old, you'll still be paying more than your schoolmate who went to college, even if you both have perfect driving records. When Consumer Reports magazine did a secret shopper test earlier this year, it found that lesser educated, safe drivers pay, depending upon the company and state, between 6% and as much as 50% higher premiums than equivalent drivers with college degrees. So at this point, it's important to note, per the purpose of our conversation today, for deep-seated historical and structural reasons, Americans with less education are disproportionately Black, Brown, and Indigenous. So while the use of education level penalizes the 59% of white customers who never got a bachelor's degree, it punishes 72% of prospective African-American customers and 79% of Latinos. Now, the story of the use of employment status and job title is pretty similar, with several, but not all, name brand insurers using a driver's occupation for rating their auto insurance policy. And drivers who are in blue-collar jobs, lower skill jobs, the service sector, as well as the unemployed, will be quoted a higher premium than drivers in every way the same, except for the color of their collar. As an example, again, from the Consumer Reports research, in one city, a driver with a clean record was charged $1,177 if they were a company vice president. But they were charged $1,274 if they were a store manager for that company. And they were charged $1,685 for the exact same coverage if they were a cashier with the company. What we find thematically from company to company is consistent. If you're working class, you're going to pay more than a white collar professional to those companies that use this factor. So surgeons get discounts while LVNs at the same hospital pay surcharges. Architects get low rates, daycare workers high rates, investment bankers pay less, bank tellers pay more, even when they all have the same driving record. So it's worth noting again that all these rating factors are cumulative. And since people who get surcharged because they have lower skilled jobs are also more likely to have less education, and going to some of the other factors, more likely to be home renters than owners, the premium surcharges accumulate precisely among the Americans least able to afford coverage in the first place. And let's also recognize the social implications of using job as a factor. Black and Latinx Americans are about 50% more likely than white Americans to be in service sector jobs and pay higher premiums. 23 to 43% are less likely to be in management and professional positions. Again, they'll pay higher rates as a result. And of course, unemployment for Black, Latinx, and Indigenous Americans is 50 to 75% higher than whites. So whatever arguments insurers may use to suggest that bankers, lawyers, and software engineers should get better deals than factory workers, cashiers, and janitors, we simply cannot ignore the fact that this pricing technique, as with the use of education, has outcomes that disproportionately harm people of color. Now, I'm sure that the insurance industry panelists will remind us that they never ask for a customer's race or ethnicity when setting premiums, but we can't ignore how their pricing shakes out with respect to race and ethnicity. The point, of course, about justice is that outcomes matter. So now I want to set that education and occupation aside for a moment and move to geography as it's used in pricing auto insurance, because I see it through a somewhat different light than the strictly socioeconomic status factors. So obviously zip code is associated with financial and social status in profound ways that cannot be ignored when looking at insurance through the lens of racial equity. But unlike the non sequitur relationship between your job title and your driving, it is not unreasonable to assert that different driving environments create different exposure risks. Driving in the city center leads to more fender benders, while driving on the open roads of more rural areas results in fewer but more severe accidents. So because geographic region can account for some of the cost of risk transfer, I'm not here to propose eradicating all geographic distinctions in rating. Now, I think you could quite reasonably decide to spread the risk across all customers within a state, but I'm not saying that it is necessary to achieve justice. Instead, what I want to offer is that the way in which insurance companies have historically relied on zip codes to carve up geographic risks looks a lot like the racial redlining that was used generations ago. We have tested at CFA rates as a function of the demographics of a zip code, and it is crystal clear that even when accounting for rural-urban differences, communities with higher proportions of people of color face higher auto insurance premiums across the country than those in predominantly white zip codes. If you overlay current auto insurance premiums onto the old redlining maps from the 1930s, it becomes painfully obvious that the dynamics and the impacts of racialized housing rules persist in the insurance sector. So one reason for this is that zip codes were created for postal service objectives, but they are totally arbitrary from an insurance risk perspective. However, of course, zip codes are freighted with this very non-arbitrary social history that interacts directly with the racial, ethnic, and income composition of communities. So in the insurance pricing context, this becomes particularly evident along those borders in many cities between a predominantly Black community and a predominantly white community. So I have examples in Buffalo, Atlanta, Baton Rouge, Denver, and several other cities where you can look at these type of zip code boundaries. So for the drivers in the community of color, the premium is sometimes 10%, 25%. I've found 100% higher rates than the whiter zip code that is literally across the street. Now, we also sort of end up with these results in part because zip codes are just small geographic units. And most people don't drive in just the zip code they live. They drive in a region and often beyond that. So while it's okay to have a way for geographic rating to reflect differences based on the type of driving environment in which one drives, we should not give it so much weight and not use territories that are so small that we end up with this sort of redlining redux. So there are a couple of ways to address this. One, you can simply require insurers to divide states into much larger regions that are more reflective of overall regional driving risk rather than the arbitrary postal demarcations. By bringing everybody in the region together and pooling the risk in a larger way, you can begin to overcome the kind of neighborhood redlining legacy that we see in the premiums today. Now, Connecticut takes a different but also viable approach that I think is worth noting, and it still allows smaller territories. There, the geographic rating factor is a combination of the local territory and the statewide costs, which have to account for 25% of the total impact. Now, if I'm writing the bill, I'd give the statewide part more weight, but either way, in this approach, you moderate the impact of local zip code by basing the premium partially on the rate needed for the state as a whole. Now, on the other hand, when Michigan adopted a law change in 2019 that ordered companies to stop using zip code, things got worse because the law didn't require a broader risk spreading than zip code allows. Instead, several insurers actually reduced the aperture of their rating model to use a much smaller territorial unit called census tract block groups. Now, this played out brutally in one Detroit zip code that I studied. As a whole, the zip code is quite diverse. But when you look at it by block groups, there's one neighborhood that is majority white and another that is 100% African American. And now using block groups instead of zip codes as a territory, one insurer charges almost double to drivers in the all Black census tract compared with the other whiter tract of the exact same zip code. The point here is that using geography as a rating tool may have some meaningful connection to risk of loss, but we should be requiring an expanded geographic footprint for setting the premium in order to overcome historical inequities. So to conclude with a final overarching point, because auto insurance is required by the laws in most of your states, you have a special obligation to develop public policy that improves affordability and prevents inequities in the market. Allowing insurance companies to penalize people with good driving records because they have non-preferred job titles or lower levels of education is fundamentally disjointed from the public policy goal of having drivers maintain financial responsibility. Similarly, the use of small, arbitrary geographic segments reinforces and perpetuates the structural racism in our society. And while there is room for some geography and pricing, the law must do a better job of spreading the risk across larger, more diverse regions rather than allowing territorial rating to cement racial inequities in auto insurance markets. So I'll conclude there. Thank you for the time, and I'm certainly hopeful to be part of the conversation as this hour moves through. Thank you.
Neil, you're on mute.
Thank you very much, Doug. And we'll have questions after the 5 speakers, so we'll hold off on those. But I thought a very informational, concise, and direct presentation. Next speaker is Roosevelt Mosley, who's the principal and consulting actuary at Pinnacle Actuarial Resources, Inc.
Thank you, and good afternoon, Chair Breslin, Representative Lehman, and members of the committee. It's my pleasure to be here with you today, and I appreciate the opportunity to share just a few thoughts on the idea of the zip code rating and a little bit on education and occupation. Just to provide just a quick brief overview, I want to back up and provide some background on maybe a little bit of the actuarial perspective on how actuaries approach the use of rating factors, and that will apply to the discussion on rating by the use of zip code and education and occupation. I will then talk a little bit about the geography rating related to zip code, and I'll touch a bit on the idea of the use of census block groups. I will briefly cover just a couple of points on education and occupation in the interest of time. I know that one of the other speakers will delve into that a little more deeply, so I will not cover that in depth. And then I'll come back and try and tie it all up with some closing thoughts. First, from an actuarial perspective, just to give you just a bit of brief background, and this is probably not new to many of those that are on the call, but in terms of the use of rating factors, the primary reason that companies use risk factors like education, occupation, zip code, and others is really to better match the premiums that they are charging to the expected loss and the expected risk that they are covering. And there are a number of things from an actuarial perspective that govern the use of insurance company risk factors. First is we have rate making principles that are promulgated by the Casualty Actuarial Society that discuss and govern how actuaries are to incorporate information, incorporate justification into the use of rates in the development of rates. And then actuarial standard of practice number 12, it's an actuarial standard on risk classification. And between the two of those standards, they really govern how actuaries tend to approach this issue. And I won't go through them in detail, but I'll just give you a couple of quick points. The first, from the principles on rate making, rates are essentially estimates of expected future costs. Insurance companies are in the business of covering risk. And in order to ensure that they're going to be a viable concern, they have to develop rates that estimate that future cost, but really to enhance the likelihood of the viability of the entire insurance system. Those overall costs aren't just the costs that need to be focused on, but also the cost associated with the individual risk transfer. And that essentially gets to the point of charging a rate that is commensurate with the risk. The ASOP, the Standard of Practice on Risk Classification, requires actuaries to select or consider risks that are related to the expected outcomes. And the expected outcomes essentially are related to the likelihood of an accident occurring and the cost of covering the claim associated with that accident when it does occur. And so the overall, again, all risk factors, and including zip code, education, and occupation, are covered under these standards. So Mr. Heller alluded to the reason behind the use of geographic rating territories, and I'll provide just a little bit of additional background. There's variance in how companies incorporate territories into rating. Some companies use zip code as a base. Some companies use census block groups as a base. Some companies use broader territories, counties, as a base, and some companies use a combination of a number of different building blocks. So it isn't just that one company uses a particular building block. And oftentimes companies don't just individually focus on specific zip codes, primarily because most companies don't have adequate experience or adequate exposure to be able to rate individual zip codes or individual census block groups with full credibility. And so generally what tends to happen is those zip codes get grouped up into larger groups that again can resemble areas that are county-based, larger than county-based, depending on the area. And those groups essentially provide the basis for rating. And so the reason I bring that up, and if you would allow me, I just want to share just one quick slide with you, because I think it helps to demonstrate the point, and I'll be brief in demonstrating the point. The slide that I want to share with you has to do with just an example of traffic density and how traffic density varies in a from state to state. This is just an example of Missouri and its data that's collected by a third-party vendor called TomTom. And for those of us that are old enough, we remember the actual TomTom navigation devices. Same company, just they're in navigation systems now. And what you can see here is that this data is actually captured by census block group. And it shows the difference in traffic density across the state of Missouri. And you can see, no surprise, as you blow out the cities of Kansas City and St. Louis, you see much more traffic density as compared to areas that are more rural. And thus the increased traffic density does lead to increased risk of loss. But I bring this up because you can see here that as you look at particular areas, individual census block groups, actually, if you look within areas around them, you can see patterns begin to form. And what companies tend to do is they tend to look at patterns, not just of the individual census block group, but of areas around it. So it allows them to build up into broader territories, but still focus on the geographical risk within the individual areas. And so what I would advocate is actually the reverse, allowing companies to begin from smaller building blocks that help them build up into larger building blocks that actually help them to better reflect the risk. And ultimately, when you smooth a lot of this out, and essentially a lot of that happens when you look at territory rating, and when you smooth a lot of this out, what you end up with is broader territory groups, as Mr. Heller alluded to earlier. So I'll pause there. I'll end there on the discussion in terms of territory. The last point I will make related to education, occupation, and geography, and the combination of those rating factors is we've been involved in looking at a number of different companies from a lot of different perspectives, and in looking at companies that use education and or occupation. Most all companies use territory. We were not able to find a company that uses all three of those elements in combination. And so but we were not able to identify a company that has different territory factors by education, or different territories factors by occupation level. They all are used as separate individual factors for the companies that are using them. And by that, I mean education and occupation are used distinctly and separately from zip code. So in conclusion, I guess I will come back to the broader point and say, again, we remain in full support of NCOIL and the work that you're doing to address the issue of systematic bias in rating. But we believe that should be done on a holistic basis. Addressing one or even two or three rating factors is not going to identify the issue. It's not going to necessarily solve the issue. And in some cases, it may not even move us closer to a resolution of the issue. And so we wholeheartedly support this effort, but strongly encourage the committee to look at this effort as a more holistic basis and not just on an individual rating factor basis. Thank you.
Thank you very much, Roosevelt. Good presentation. And we'll move on to the third speaker, Tony Cotto, who's been with us before, who's the Director of Auto and Underwriting Policy for the National Association of Mutual Insurance Companies, who are commonly referred to as NAMIC.
Thank you, Mr. Chairman, Representative Lehman, and the rest of the committee for having me back to speak today. My name is Tony Cotto. As the chairman said, I'm Director of Auto and Underwriting Policy at NAMIC, where we firmly believe that the elimination of racism improves every aspect of our relationships, institutions, business communities, and that treating all policyholders with dignity and fairness is essential to the continued success of our industry. When we talk about fairness in insurance, we're talking about the effort to match rate to risk based on economic, insurance, and actuarial principles. Because not all risks are the same, neither are all rates. I say this not to be cute with a truism or to insult the committee's intelligence, but to emphasize what we're really talking about. When we talk about fair underwriting factors, we're talking about the principles of risk-based pricing, matching rate to risk as accurately as possible based on expected losses. As the committee continues its consideration of underwriting factors today and into the future, I encourage you to bear in mind that no single factor accurately measures the totality of risk represented by any individual consumer, and that restrictions on rating factors and rate differentials undermine accuracy, force less risky consumers to subsidize riskier consumers, and can cause market distortions that affect affordability and availability of coverage for your constituents. In sharp contrast, the use of more actuarially sound rating factors makes unfair discrimination less likely. More factors promote more accurate predictions of future risks, more competition, and increased consumer choice. More, not fewer factors help create fairness in pricing. For purposes of today's discussion, I've been asked to focus on the 3 rating factors in the meeting announcement: ZIP, education, and occupation. I will address these in reverse order, given Mr. Mosley's excellent commentary around the territory issue. And then I'll briefly respond to a couple of the comments made earlier. At the outset, I want to address also a concern that you may have heard about the dangers of inaccurate or bad data purchased from third parties. For the factors we're talking about this afternoon, this information is collected directly from the applicant seeking coverage, so the risk of inaccurate reporting is minimized. I also want to include a brief note about the debate that this committee has already heard much of regarding causation versus correlation. While the idea of causal factors is intuitive and it's very appealing, it is imperative to understand causation is simply not a meaningful or workable concept for insurance companies, for regulators, or for legislators. There are no factors proven to have pure causal relationships to losses. No factor could survive such a requirement. The current state of actuarial science is appropriately focused on correlation to the likelihood of a loss. Earlier, I jokingly shared with you the platitude that not all risks are the same. Well, here's another one. Not all jobs are the same. They do not all carry the same risks, nor do they attract the same talent pools across companies or across entire industries. For instance, in professional liability insurance, rates are different for surgeons than for general practitioners, for nurses, and for anesthesiologists. Doctors' professional liability rates differ from those of lawyers and accountants. Workers' compensation, life and health, and disability rates all differ greatly based on the type of work performed at various businesses. To keep picking on attorneys, I can do that, I used to be one. It's safe to say that there is a much greater danger of a paper cut for us than an industrial accident at any given moment in time. Pretending this is not the case would yield truly bizarre results. The high-level relationship between occupation and risk also manifests itself in other lines, like private passenger auto, sometimes in easily understood ways, like travel patterns, locations, and frequency, sometimes in less obvious ways that still contribute to loss probability. Things like stress levels, attention to detail, responsibility for the safety or well-being of others, tendencies to be distracted. I often think of doctors and pagers, sleep deprivation, and even the frequency of substance or alcohol abuse within an industry or occupation. All of these things matter. 2 final considerations when discussing occupation are understanding who benefits and the availability of very popular discounts. As I've alluded to, some professions are shown to have lower likelihoods of experiencing losses, including many critical public servants like firefighters, teachers, nurses, airline pilots, and members of the military. A prohibition on the use of occupation would hamper insurers' ability to reward these consumers for their lower risk profiles, while also limiting the capacity for some of the affinity groups and organizations to which these folks belong to negotiate even more discounts for representing statistically less risky populations. Staying on the idea of discounts, I'll segue into the discussion of education. The same type of occupation-based affinity groups I just mentioned also exist around things like alumni groups looking to provide value to their members. The good student discount is one that has successfully permeated popular culture and is beloved by hundreds of thousands of parents of teenagers. These discounts are approved by regulators as actuarially sound, and they reflect choices made by a student that speak to that student's level of responsibility and maturity. With respect to educational attainment in the rearview mirror, historical data shows that drivers with higher levels of educational attainment are less likely to experience losses because they are less likely to participate in high-risk behaviors, things like drinking and driving or disobeying laws. On a large demographic basis, the American Academy of Actuaries and extensive studies by multiple regulators in places like Florida, New Jersey, and most recently in Maryland, just 2 years ago, have all confirmed that there is actuarial support that these rating criteria represent fair discrimination between risks, the crux of underwriting. The most recent Maryland report even went out of its way to point out that the department could not identify a single consumer complaint over the use of occupation or education as a rating factor. Now, not all companies use occupation or education, and they certainly don't use them the same way. This is actually a perfect illustration that a healthy, competitive market is allowing for independent decisions by industry competitors where underwriting and rating methodology is concerned. I'll touch briefly on zip codes as well. As Mr. Mosley alluded to, geography is an incredibly important consideration in pricing. Again, using auto as an example, reams of historical data indicates that the reality is that crashes, vandalism, and theft are more common in urban centers, most likely due to population and traffic density, road configurations, and the absence of garages. Suburban Louisville, where I live, is not New York City. And if I drive about 20 minutes east, I'll be in a zip code that's home to more horses than people. The risk profiles of these areas are simply different. Similarly, the risks of storms, floods, and other natural disasters vary across geographical areas within a state or even within a metropolitan area. And that must be reflected in the way insurance policies are underwritten and rated, all of which are, again, approved by regulators at some point along the way. I want to take a moment to address the comments regarding the Consumer Reports study on education and occupation, particularly. Consumer Reports actually admits in that study themselves that they do not intend it to be a nationally representative analysis. They studied 869 preliminary quotes in 21 zip codes, which is certainly not representative. And the study actually admits, and I'm quoting directly from the Consumer Reports study, the Consumer Reports team did not attempt to identify or fully understand all of the variables that affect quote premiums. There are significant concerns with citing a study like that. Furthermore, what the study actually found, contrary to the splashy headlines, is that in several cases, the individual with the quote unquote higher or better title actually paid more. So to represent that education and occupation because of one Consumer Reports study on quotes, which never actually went into a final price, should indicate anything to this committee is just not accurate. I also want to address the idea of socioeconomic variables and direct the committee's attention to a recent study that NAMIC commissioned by Dr. Robert Klein, who took a look in depth at the data provided by the regulators, by the NAIC, in their auto study working group that took 8 years to crunch some data around auto. Dr. Klein looked at income and the socioeconomics of income and geography and did some comparisons and found that, if anything, lower income areas receive more benefits in relation to the premiums that they pay when you look at insurance. So I'm happy to talk more about that in Q&A. And I'll wrap up, as this committee continues its important work, a few final thoughts. Factor interaction is neither monolithic nor static, just as our policyholders are not static. As consumers move, change jobs, attain more education, their risk profile constantly changes. At the same time, actuarial formulas are constantly evolving and being recalibrated, and the relative value and weight of different factors, all of which are submitted to regulators, continue to change. Second, risk-based pricing benefits consumers. It reduces cross-subsidies, it enhances competition, and it lowers average costs. Risk-based pricing also benefits society at large by allowing insurance to serve as a financial incentive to modify behavior in the name of safety. Third, and perhaps most importantly for purposes of this committee, the underwriting analysis of education, occupation, and zip code is in no way limited or even informed by race, because race does not matter for purposes of analyzing the likelihood of a loss. More factors makes racism less likely and improves the fairness of pricing for all consumers. Thank you for your time and attention today. I'm happy to remain online and answer any questions when the panel is over. Thank you.
Thank you, Tony. We're going to have a lot of questions putting them all together. Our fourth speaker is Peter Kogenberger, who's been with us before, who's the Executive Director, Insurance Law, the LLM program, the Deputy Director of the Insurance Law Center, and Associate Clinical Professor of Law at the University of Connecticut School of Law. Peter.
Thank you very much, Senator, and thank you again for inviting me to participate in this event, in this meeting. I'll address three factors quickly. One is the concept of fairness. The second is, what do these models really mean? What do these factors, how do they likely affect state insurance markets? And the third is, are there other choices or better choices than occupation and education, as well as zip code to use? So first on fairness, I'm going to have to disagree right out the bat with Mr. Cotto. Actuarial fairness, that does the rate, the risk classification do what it is said, is simply one of two very important factors. It's never been the sole factor. Fairness is a broader concept, and you can find that in many regulatory standards. And that is, first is a two-part test. One, does the risk classification measure risk as it says it does? That's necessary, that's important, but is no way sufficient. The second is, does it violate public policy? And that's where you all come in, along with the regulators, but particularly state representatives. And we have plenty of examples of that. Race, let's assume race or particular race or religion was actuarially demonstrated that there was a correlation between one's skin color, one's race, and risk. We don't allow that. And it's not because, well, we're suspect about the math that went into it, but because there are other important aspects of insurance and insurance markets in our society that trump that. To go to another example, and one more immediate, is the use of the prohibition in the Affordable Care Act and in employer-based insurance, the prohibitions on using pre-existing conditions to rate health insurance. Obviously, that's one of the most relevant factors in terms of how much someone's healthcare will cost the next year. We don't allow it, not because it's not understood or not because it's not predictive, but because there are other public policy goals that are determined by legislatures that override that. So in fact, that to consider fairness as only actuarial fairness is only half the job. It would only give you half the role that you're supposed to play, that regulators play, that the federal government plays in other areas. Second is, what do these factors actually mean in terms of, particularly again, education and occupation? And I think one issue is, do they actually increase access? Or are we working within the same risk pool overall? And unless education correlates negatively with risk, the more educated you are, the more risk. Of course, education correlates, of course, the more education you have, the better. And I think the Consumer Report study that was mentioned is a very good one, but it doesn't matter. regardless, there are more studies over the last 30 or 40 or 50 years than there are people on this call that clearly demonstrate that occupation and ethnicity and education and ethnicity and race are clearly correlated and not to the benefit of people of color. That's not a that's a sad fact. It's one that hopefully is getting better, but there's no serious argument that education and race correlate. Not because that's the intent, but that's the effect. So to use these factors does not, again, assuming that education, the more education is a better risk factor, which I think is the assumption that I know I have based on these discussions, is that it is also therefore going to disproportionately burden people of color. Now, it's up to you all to decide whether that disproportionate burden is worthwhile, but it's a decision that needs to be made by the public, by government, not by private industry, any private industry. And second, within this risk pool, or within the state risk pool, we often hear, well, if you don't allow these factors, some people who are going to pay more than they do now. And that may be true if we don't allow, or if you don't allow education and occupation, or if you limit by zip code. But the corollary is also true. Some people are already paying more now because of those factors. So this shifts who are the winners and the losers within the risk pool. So it's for no arguments that the use of education or occupation actually increases access to insurance for people who otherwise couldn't afford it. Remember, we're talking about personal lines issues here largely. We're not talking about lawyers and doctors. They can look after themselves better than most. So what we're doing is shifting how much people pay, not reducing overall the cost of the insurance pool, whether the auto pool, nor likely increasing access to that pool. And this allows, what these factors do, and the hundreds of other factors that are coming in all the time, is they allow insurers to better predict, better evaluate, and market to the best risks, those less loss. There's nothing wrong with that. That's what private insurers are supposed to do. That's part of their function, is to predict risk and target those appropriately who have less risk. But it is not what the insurance market overall is supposed to do. It's especially in auto and homeowners and renters, which is to provide access to a necessary product whose necessity is well beyond not simply the policyholder and insurer, but to the state as a whole, to the public as a whole. So these factors, allowing these factors, I don't doubt for a second that insurers are not attempting to discriminate on the basis of race. But as Doug said earlier, that's not the point. It's the outcome that matters. And these outcomes, particularly with education and occupation, which I think, and there's a couple other factors in which we look at, in which there's such a clear correlation, both in terms of race, and very low likelihood that it actually increases access. What this means then is that, again, insurers are race and depict the best. And the market exists for all of us who can need and can afford insurance. The third factor is part of this, and as insurers, as these classifications pick winners and losers, do you want that to be based on our education and occupation, even if it is a correlation? Because again, for two things. One, as I mentioned, while there's an uncertain correlation, but between, and certainly very uncertain causation between our education, occupation, and risk, there is a very clear correlation between education, perhaps occupation, I think occupation as well, and race. So are these the factors that you want insurers to pick winners and losers? Because that's not a market decision ultimately, that's your decision. And then what are the alternatives if it's not allowed? Well, first, this is not the end of risk-based pricing. I am very glad we didn't hear that argument today. We've heard it here and other places that simply restricting one or two factors ends the insurance world as we know it. And that's not the case. There are other better factors that are, as far as we know, far less, that correlate far less with race And we also know, and a growing number of them, and they have their own problems perhaps, and we've talked about that. You've talked about that in the past, and there are ways to determine whether they're having a negative effect. But these education and occupation are particularly associated, again, with race. So there are other alternatives. This is not the end of risk-based pricing. And also we have, for example, telematics, or also known as usage-based insurance. Now, this is not a panacea for all problems by any means, but instead of evaluating using proxies to measure risk, which is what any risk classification essentially is, now insurers, at least in many areas, with consumer consent, can actually measure the risk itself. How is this person driving? And while again, it is subject to some concerns, privacy, transparency, but it certainly, I think, alleviates significantly concerns about disparate impact. Disparate impact, of course, it may be a factor in many areas, but auto-based, usage-based insurance, telematics reduces that, I believe, far less. So we have better factors, better risk classifications, better abilities to measure actual risk, whether it's additional risk-based factors or ones such as education and occupation, then education and occupation. So again, just to summarize, so fairness is and always has been, and I believe, and I hate doing this because one never wants to say something that's in the sector, but in terms of what Mr. Cotto said, I in fact think if you look at actuarial principles and ethics, that in fact fairness is more broadly defined also in terms of public policy, although as determined by the public, by government. Secondly, what these factors do to pick different winners and losers within the same risk pool. They don't. There's no evidence, concrete evidence that they actually expand or expand the pool or make insurance overall more affordable. In fact, where insurers, for example, are collecting less premiums than before because they can more accurately determine risk. And finally, there are other and better alternatives to using these factors. Thank you.
Thank you, Professor. And our last speaker is Jan Graber, who's a senior actuary at the ACLI, the American Council of Life Insurers. And just as a reminder, the slides of Jan will be on the NCOIL website, as will any other documents from the prior speakers. Go ahead, Jan, you're on.
Thank you so much. And my colleague, Karen Melchert, is in the process of sharing my slides. So good afternoon, I'm Jan, senior actuary at the American Council of Life Insurers, and I was asked to speak briefly on the use of several factors in underwriting life insurance products. So I wanted to start briefly by kind of level setting with some key considerations with respect to underwriting life insurance products. So first of all, risk classification is a basic premise of private voluntary insurance. And this voluntary insurance market depends on an accurate assessment of risk to enable insurers to make products widely available and at the lowest possible rate to as many people as possible. Underwriting decisions are not based solely on one factor. We take a holistic approach to our underwriting, and we consider a range of factors that impact mortality and morbidity. And by law, we must be able to demonstrate that any factors used are justified by sound actuarial principles or reasonably anticipated experience and result in individuals with similar risk being treated consistently. So because life insurance, long-term care insurance, and disability insurance are generally long-term financial protection products, accurate risk assessment is key. This can only be done if we have accurate and complete information regarding the risk being assumed. So I will focus today on the use of occupation, zip code, and education level in underwriting products. So I'll look briefly at the use of these factors, how they're used separately, and then how they're used sometimes in combination with other factors. So starting with occupation, the use of occupation is one factor that has more of an intuitive connection to the risk being assumed. So obviously, some occupations are more hazardous than others, and this could impact an applicant's mortality or morbidity. So someone working on an offshore oil rig, or someone working in the lumber industry, or a professional race car driver, an aircraft pilot, they're going to expose insurers to a higher mortality risk than someone who just sits inside behind a desk all day. Occupation is also a factor that is used in determining eligibility for and suitability of coverage, and also for fraud protection purposes. So for an example, an underwriter might consider occupation in validating the income amounts that are stated on the application. So this will help inform the underwriter as to whether the desired coverage is reasonable in relation to the financial risk being assumed. So for example, a childcare provider or an assistant manager at a retail store applying for a $10 million policy is going to prompt an underwriter to take a deeper dive into the application. It doesn't mean that the coverage won't, but rather causes the underwriter to ask additional questions. Why would an individual making $50,000 a year need a $10 million policy? And like I said, it doesn't mean that the policy was issued. It just means that the underwriter must look at additional factors to help explain why the coverage applied for is, makes sense in relation to the risk that's being insured. So next slide. An applicant's use of zip code is not really used in underwriting or issuing individual policies, but there are exceptions. These exceptions are generally in issuing in a corporate or business type setting, and not necessarily to do a mortality assessment, but more to look at the insurer's concentration of risk. How much risk is the insurer exposed to in one particular area. So for example, a company insuring professional athletes will look at concentration of risk and the potential for a catastrophic event. So if a team takes a private jet to a game and the company insures the entire team plus the coaching staff, the company could easily be sitting on over $100 million of risk in the event of a catastrophic event. Another example, you might have a wealthy family that has a family office, and there are multiple members of that family that work in that office. They might all be buying individual policies as part of an estate planning strategy. The company might take into consideration that concentration of that risk. So 4 to 5 family members with $50 million policies, the company is sitting on $250 million of exposure. A more common example is, a company that issues policies in an area with a high propensity for tornadoes. They would want to manage how much risk they have in that area, making sure they don't have an overexposure in one particular area due to a catastrophic event. So most of the focus on the concentration of risk is on employer-sponsored plans. An employer that has 100 employees in a single location, in this situation, even if the company issues $1 million policies on each employee, that's $100 million of exposure. So the coverage doesn't have to be a high face amount. And historically, no one really thought about concentration of risk with group life insurance. But then we had 9/11, and that really changed the way that companies look at concentration for risk for group life insurance. So in summary, zip code might be used for risk management, but not for risk stratification. And even though where you live can impact your mortality, so there's this theory that People with lower incomes might have a higher mortality because of where they live. They might have more access to fast food restaurants, less access to gyms or medical care. But as an example, you could have a very high income earner living in an affluent area. They live next to Whole Foods. They have discretionary income where they can seek medical care or participate in healthy activities, but they might not choose to use their income in that way. They might drive 10 miles to a fast food restaurant. They may never even step foot in a gym. And then on the flip side, you could have, you know, a person that lives in a low income area near lots of fast food restaurants, and they're vegan, very healthy. And at the end of the day, it's their medical history that's going to show up differently. And that's what they'll be rated on. So just because they live in a poorer neighborhood doesn't mean that their health profile is worse than someone who lives in a more affluent neighborhood. So if I apply for two identical policies with the same company, it doesn't matter where I live. I can use a different address on each policy. I'm going to get the same rate because they are underwriting me and not where I live. So finally, zip code often is used in marketing models to identify target markets for the distribution and sales force, but again, not for risk stratification. Education level is not used very much at all, if ever. Carriers don't ask for this information on applications. However, there is a correlation between education and a lot of things. So it could help the underwriter determine if the amount of coverage the applicant is applying for correlates to their needs. So whether it be for income replacement or estate preservation. So education often overlaps with occupation. So for an example, you know, a medical resident straight out of medical school might have a low current income compared to the amount of coverage that they're applying for. And this doesn't mean that the coverage won't be issued, but rather it prompts the underwriter to take a deeper dive. They will look at their occupation, which is often an indicator of education level, and they'll take into account the potential growth of their income. So like zip code education is mostly used in marketing models to identify target markets for the distribution and sales force and not for risk stratification. So in summary, accurate assessment of mortality and morbidity risk is key to underwriting life insurance products. And this assessment requires sound actuarial principles and or reasonably anticipated experience to support any premium or benefit differences among classes of insured. So the clearer picture that insurers have of the risk the applicant exposes them to, the more accessible and affordable products will be for everyone. And I'm happy to answer any questions.
Thank you very much, Jan, and compliments to NCOIL for picking 5 speakers who were eminently qualified, who presented, after the presentation, presented a number of different questions between and among your positions. So we'll hear from that because our next part is a discussion by the committee members. And so anyone, and then we'll take other legislators and then any outsiders who would like to ask questions. So members of the committee, Will will be there trying, and Will and I will help figure out who goes first. And anyone have any questions or discussion? Tom? John? Kevin?
Mr. Chairman, Assemblyman Cahill has his hand raised.
Okay. It's Kevin Cahill from the great state of New York.
Thank you. And Neil, I almost was in the Capitol today, but I was able to avoid it. Thank goodness.
Congratulations.
Thank you to all the speakers. I think this is an important discussion. And I think the real framework was put together by the fourth speaker, I guess, Professor Korchenberger, in that actuarial information is important, but it is not solely important. Public policy also counts. But one question that I would have, particularly for the last speaker, who mentioned the element of fraud, Ms. Graber. Fraud seems to be a great go-to for the insurance industry, yet when I have asked the insurance industry to quantify it, to give it a dollar value, they're hesitant to do so. I suggested 2 years ago to the property and casualty industry that if we imposed every single one of the anti-fraud measures that they wished for, how much would they lower my insurance by? And they wouldn't tell me. But at the end of the day, the best number we could come up with was something in the 1 or 2% range. So with this emphasis on avoiding fraud by, you raised the issue about the low wage earner seeking a high life insurance policy. I mean, I understand that that's odd, but so what? A lot of things are odd. People collect toys. That's odd. Just how much of a factor actually is fraud in the everyday operation of the insurance industry? It seems to be the go-to.
Well, I can't speak to exactly, what the impact is on premium or that kind of thing, but it does tie to that intuitive. Why would a low-income worker need a $10 million policy? And that could happen. And again, it doesn't mean that low wage worker won't be issued the policy. They may have a trust fund or have, family money. We don't know, but what it does do is requires the underwriter to go and look for that additional support, whether it be, look at other financial information. Another issue can come up as to whether, can they afford the premium? If you're a low wage worker, can you afford the premium on a $10 million policy? And so there could be, underwriters want to make sure that they've looked at the reason for the coverage and make sure that it makes sense.
Well, I would just suggest that that fraud is oftentimes used as a reason. Fraud avoidance is oftentimes used as a reason to do things that might otherwise offend public policy. And in fact, the inability of most people in the industry to quantify and in particular put it in the context of what consumers would save on their premiums leads me to wonder whether it's something that is sort of a gut instinct or something that is actually scientifically established and has a basis in reality. I do think that it is a place where we often hide. We hide behind fraud, oftentimes to justify actions that we might not be able to justify in other ways or that come into question. So I thank you for your answer. And Mr. Chairman, I'll give it back to you. While I have silence outside my window, there's construction taking place, but I had a moment of silence. So.
Anyone else with questions? Will, Tom, do we spot anyone?
Senator Hackett.
I don't see it. Great.
Senator Hackett from Ohio.
Yeah, no, and I think the world of Kevin. Kevin, one thing is, when I was a vice president of a company, a big insurance company, I spent a couple months in underwriting. And remember, in underwriting, it's not just fraud. It's also, you want the facts. I mean, sometimes people don't do it for fraud, but sometimes people know their health changed and they know their chances of dying is so much greater, but there's just nowhere on record. So there's a lot of reasons why, you want to make sure you do complete underwriting. It just makes sense, to do that. Like I said, it doesn't mean they won't issue the policy, but it just makes sense. Why would somebody, apply for something out of the ordinary? The one professor, the only question I said, Professor, and I don't want to get off on an issue on Obamacare, but you mentioned about, Obamacare, and I knew I worked partly in the industry and provided benefits, so I knew there were issues, et cetera. But one thing, people hesitate to say is if someone had coverage and was currently coverage, pre-existing conditions did not come into play. So the ones that got damaged and actually given up their coverage. Maybe it got too expensive to keep, et cetera, and they were trying to chance it. And then they developed a health condition after the fact. And then, of course, they couldn't buy any coverage anywhere, et cetera, because they had a pre-existing condition and had no existing coverage that would continue. So the media doesn't always want to show the full picture of the scenario of the thing. So I just want to make you aware of the fact that the pre-existing condition coverage on Obamacare, yes, it was important, but it was also important because people went without coverage.
Thank you very much, Bob. And we'll move on to Pam Hunter from the great state of New York and one of the best insurance legislators that we have.
Thank you, Senator. Good afternoon, everyone. So I wanted to ask Roosevelt a question. In his presentation, he spoke about wholly looking at factors, I guess, in all of it, instead of just identifying a few of the risk factors. And I'd like him to expand on what would that look like. And then it appeared that a lot of the conversation, and I think Otto Cato, I believe, brought up about causation, but it seems like a lot of the conversation and maybe assessment really isn't causation at all, but really correlation. And to me, the correlation factor can reach back to discrimination. So if somebody could maybe take a dive into that, but also if Mr. Roosevelt could expand on that wholly, looking at the factors instead of just picking out a few. Thank you.
Sure, I would be happy to address the first, and then I'll maybe touch on the second and leave it to Mr. Cato to handle the bulk of that. So in terms of the idea of holistic, what the point I'm trying to make is that oftentimes as we have these discussions, the focus zeroes in on either single factors or, in this case, a group of 3 factors. And oftentimes the discussion is reduced to the conclusion that if we eliminate this factor, then rates will be fair or more affordable or whatever the desired outcome is. And I think what we've learned from years of studying this issue, I think this point actually came out really clearly in the FTC study they did on credit-based insurance score way back in 2007, is that the answer is, the real answer is much more nuanced than that. It isn't just if I eliminate zip code, then the racial bias will be eliminated or even significantly reduced. If I eliminate credit-based insurance score, then all of a sudden the racial bias issue will be solved. It really involves, I think, a more holistic look at just the final outcomes. Ultimately, premiums that are coming out and research on determining, one, what's the definition of unfair? What's the definition of problematic? And then testing the outcomes against whatever that definition is. But in terms of the holistic look, I'm essentially recommending looking at this as a holistic issue rather than assuming that if we deal with 1 or 2 or 3 factors, that's going to solve the problem. Does that help?
Yes, thank you so much. And
Sure.
I guess Mr. Cato with the other, or sure. I guess one of the other people had their hand raised as well to potentially answer. Thank you.
Thank you, Assemblywoman. Yes, I will gladly address the point you raised about, this correlation versus causation, and doesn't correlation tie back to discrimination? And the answer is yes, but it's the question of what kind of discrimination you're talking about. When you talk about fair discrimination, we're talking about discriminating among risks. That's what this is about. This is about discriminating among risks that are more or less likely to result in a loss. And candidly, there is no incentive for insurers to engage in unfair discrimination. It's a bad business decision based on erroneous biases that would hurt an insurer financially and undermine its business objectives. So there are no incentives for this. Hopefully that addresses the question, but yes, I mean, fair discrimination is what we're talking about here.
I think Mr. Heller, you had something you were going to say. Thank you, Tony.
Yes, Mr. Heller. Doug.
If you don't mind, thank you. I wanted to respond briefly to both of those points. First, to Roosevelt's point, I generally and genuinely agree with his overarching assessment that this is a balloon, and if you push on one part of it, the air is just going to move to another part of it. And so we really do need to take a kind of a holistic look. And there are ways to do it. There are ways, and we do this in other lines of business. And in fact, at the NAIC, in talking about the impact of race in writing, the on the health side, there was a discussion of actually collecting data about customers' race and trying to unpack whether or not there were what we call disparate impacts and address that. So there can be a larger way to go, but I do want to disagree, and I think we should. I think we should think about a holistic approach that says, are we seeing outcomes that we don't like as a matter of public policy, and then how do we address that overall rather than one by one? But I want to just take a little issue with the point that it's not going to do anything, because California actually does have some restrictions on the way zip code is used and limits the types of factors that can be used. And I have tested this around and compared California results by demographics compared with other states. And we do get better results in California than in other states where you have those limitations. It's not perfect. It hasn't solved the problem, as Roosevelt rightly points out, but we do make some progress there. So I don't want to dissuade you from working on these things, but he's right that there's a little bit of a whack-a-mole problem. If we get rid of education and occupation, like you did in New York, and quite effectively, I think, there is the possibility that another rating factor tied to race and ethnicity just pops up and maybe doesn't fully replace it, but still there. So then secondly, on the correlation causation piece, I think it's important to note, even when Tony was sort of sharing his thoughts on who gets punished and who gets the benefits in other lines, he was talking about liability coverage. Well, we understand why there's different liability and a real causal relationship between what a doctor does and what a lawyer does or something, or in life insurance, we understand that somebody who walks on a high wire is different than somebody that sits at a desk. There's a causal understanding. When he talked about auto insurance, he said, you think about people with lots of high stress levels and lots of sleep patterns and doctors looking at their pagers. But what we see every time is, despite the fact that doctors are on call every other Saturday night, they're getting the best rates, but a janitor who works very hard but probably isn't on call quite the same way is getting the higher rates. So whether or not there may be some correlations, it doesn't even add up in a causal relationship. And the point that I think Peter rightly made is that as a public policy matter, you have the right to overlay your view of the world as to what type of discrimination public policy should be looking at, not just the actuarial discrimination that Tony's focused on.
Peter Kogelberger, I'll get back to him. Thank you, Doug. Peter Kogelberger, you have a question, I think, or a response?
Thank you. Just two quick points. One on the correlation and causation. I mean, I agree with what Doug said and several of the NCOIL members, but I think one issue is to look at is what can the consumer or the policyholder do about addressing those risks? I mean, we can drive better, we can install better safety devices in our homes, our factories. So risk-based pricing that gives us policyholders or potential policyholders information that allows us then to act or address those risks to reduce them is very important. Yes, of course we can affect our own education and occupation, but no one's going to do that or is able to do. First of all, many people can't practically do so, but no one is going to do that or look at education or occupation as something they have to address or change because it'll give them better access to insurance. So these are not factors, along with some others, that that translate into action that benefits the policyholder, the insurer through fewer losses, and society overall. Your major concern, because money is always better spent, resources and money are always better spent, not in paying, not in paying or mitigating claims, but not having them in the first place. And then the second point is, because I think ACLI, Jen, did a very good job in terms of explaining the importance. This is not all or nothing. I mean, there are, and as Doug just mentioned too, there's certainly some places where, occupation or income, for example, could be useful. I mean, and the most, and underwriting life insurance policies is certainly one of them in terms of determining whether the ability of the consumer to pay. That's not what it's typically used for outside of life insurance. In fact, it's almost irrelevant to that factor. And recognizing a couple, several exceptions to why it should be used doesn't mean that, at least in my mind, doesn't mean that you should therefore allow it in every use. Thanks.
Thank you, Peter. Roosevelt, you've had a response. And Matt will be next.
Yes, just very briefly, just to clarify the point I was making earlier, I wasn't making the point about one factor at a time in expectation that companies would adjust, although obviously as some factors leave, companies adjust. The broader point I was making is that if we're not careful, there are factors that can be attacked or labeled as problematic, and then ultimately when they're removed, they don't really get us closer to where we're trying to go or help with the overall situation. And then the last, I'm sorry. Okay, and then just quickly, the last quick point I will make is that in terms of specifically the risk. The auto rating program in California. That's an example of what I'm trying to kind of describe. Mr. Heller talks about the research that he has done that has shown that essentially the approach taken by California is less discriminatory. But in contrast to that, there was an article published probably 4 or 5 years ago by ProPublica, which essentially called out 3 or 4 different states for essentially allowing insurance companies to overcharge minority areas. Ultimately, there were some issues with that study, and it was found that wasn't exactly the conclusion. But California was one of those states that was called out based on their use of geographic rating for allowing companies to overcharge minorities. And so they're based on how those studies are done, there isn't even agreement on whether the California study has actually helped in the area of discrimination or not.
Thank you, Roosevelt. Now on to Mr. President, Matt Lehman.
All right, I'm getting here to my unmute. Thank you, Mr. Chairman. I would say, yes, I'm hearing the word holistic, and I'm also hearing back feedback. But anyway, I'm hearing that term holistic. I guess my issue is, do we see on the horizon?
Excuse me. Everybody mute.
Maybe it's in my end. There we go. What I see, and I guess a broader, maybe go back to the 30,000 foot view here. When I hear holistic, I guess I'm thinking we started with credit scoring. Then we went to these other factors of zip code and occupation and education. It really isn't this a bigger issue of just the whole thing with artificial intelligence coming into the rating factors and coming into the issue of rate. And so set discrimination aside for a second, is how is all this going to play out long-term? And some of that raises my question of just transparency. As an agent, I have a lot of clients who will ask me, so what has caused my factors to change? And I don't know the answer to that. So is some of this not so much what's in those, but how transparent are those to the consumer? So I guess moving forward, NCOIL, this isn't the last we're going to have a discussion about factors, but I think they're going to move beyond somewhat the issue of how they affect race and underwriting as much as is just long-term. We're seeing a real shift in underwriting from that law of large numbers to that very, very close predictive modeling. And so I'm just curious how AI plays out long-term over this. And this is the crux of it to begin with, but it's going to get broader. So I'm curious from some of the experts where they see this going more long-term.
Anybody who's willing to take that among the speakers?
Well, I'll just this is Doug. I'll just briefly say, one, I have very serious concerns about exactly what you're saying. We have done polling, and there's been some academic research published this year on the issue of the factors that are used. And when asked, people actually, it's not about just knowing that they use what factor affects their rates. People very explicitly reject the idea that their education or their occupation should be included in their auto insurance pricing. So I do think there is an element of public awareness. The people asked always say, rate me on my driving, not who I am, along the lines of what Peter was saying. So there are signals that say, if you're a good driver, you'll get a discount. As AI and the machine learning develops new tools that we can't even parse that, it makes it much more difficult, one, for consumers to know why their rates are changing, but also what they need to do to improve their rates. And that's a very big concern. And the other problem that I will add, which layers on this particular issue of race and ethnicity, is that we have a significant problem with not yet understanding how historic bias and ongoing kind of input bias affects AIs. So we may actually be spitting out even worse versions through kind of like recursive learning processes than we have now in terms of rate. So we have to be very careful to try to overlay this view of a holistic approach onto AIs. Otherwise, it's going to get way ahead of us real fast, and it probably is already on the verge of being ahead of us. So I take your point. I think it's really important that we spend some time trying to slow that down and unpack what's going into these machine learning tools before we start allowing them to be used in rate making.
Thank you very much, Doug. We'll move it on to any other legislators have questions. Speak up because I can't spot you on the. Okay, Matt, I'll turn it back to you.
All right. Well, I would just basically say again, thank you everybody who's participated. I really feel of all the ones that I have attended and been a part of, this one came with a lot of very, very good data, very, very good information. And I think it does lead us to, transitioning into maybe kind of a broader discussion. So again, I thank you, and I'll make this very brief. I know it's about 2:30, and my iPad's down to about 2% on the power, and I was going to shut my video off, but if I'm the last speaker, I better not do that yet. So I want to thank Chairman Breslin for the work he's done on this. Again, there's a scheduled meeting in Boston to bring this to a conclusion. So I appreciate everyone who has participated. Thank you to the legislators who've taken their time today, and the industry who's been here. Our presenters, I think, did a great job today. So thank you very much to all of you. Hope to see everybody in Boston.
Okay. Thank you. We'll accept a motion to adjourn.
Mr. Chairman, before you do, there are still two people with their hands up, Mr. Korkenberger and, Mr. Maletti just took his hand down. So just Mr. Korkenberger.
Okay, Peter.
My mistake. I get on students when they forget to do that as well. I apologize.
And anyone else? Any other interested persons have any questions? Okay, now we'll accept the motion to adjourn.
So moved.
So moved. Second. All in favor. Have a wonderful weekend.
See ya. Thank you.
Happy Juneteenth.
See you in Boston.
Yeah.
See you in Boston.